Well, good morning, everybody. It is not quite the glistening sea and sunny beaches of Cannes, but I have been told that it is actually warmer here today in London than it is in Nice. So that's a win. So welcome to this session, How Are We Driving Inward Investment? Thank you so much to our panel for joining me here today in person and also dialing in from Singapore. So I'm going to introduce everybody and we're going to recreate this session as if we were out in Cannes with the real MIPIM feel to it. So let me introduce the panel. It's less of a panel, actually, more of a chat. Jackie Newstead, partner and head of real estate industry sector at Hogan Lovells. Will Matthews, head of commercial research at Knight Frank. Alex Price, chief executive UK of Fiera Real Estate. And joining us on the line from Singapore, Emily Ralph, partner, director of capital markets, Knight Frank. Thank you all so much for joining us. So we're going to go through some of the key topics that we wanted to discuss in this session. And before we do that, we're going to get a bit of an update, we're lucky, from Emily in Singapore. And I didn't want to say the C word, but she's going to give us a bit of a coronavirus update because I think that would be very reassuring. But before we do any of that, Will, I believe that you have a presentation. So if you'd like to kick things off, that would be great.
Good morning, and thanks very much. I think clearly the news at the moment is absolutely dominated by the impact of coronavirus. No getting away from that. We saw stocks selling off yesterday at a record pace. Oil down to its sharpest fall since 1991, I saw. But I think if you cut through the noise, the drivers of capital into real estate globally are actually, in many ways, largely unchanged versus where they were this time last year. I think global growth is still slowing. Inflation really nowhere to be found. The situation has, of course, been exacerbated by current events. So we're seeing the economic impacts brought forward, I think. But also the response of policymakers is key. We look at what governments around the world are doing. They're pump priming their economies with extra spending measures, extra fiscal measures to try and shore up growth. We're seeing central banks doing unusual things, cutting interest rates at unusual times and pledging to do more. So you can question the effectiveness of that for the man or woman on the street and individual businesses. But it's hard to deny that is having an impact on financial markets. And one way of looking at that is the US yield curve. Now, this is a curve which shows the maturities of different government debt instruments and the yield on those over time in the US. And I took this snapshot on Friday. It's already changed dramatically since then. So now, if we look at the same chart, all of the yields on that chart are below 1%. What does that mean? Essentially, this is investors piling into safe haven assets. And they're doing that because they have a much more pessimistic view of the pace of global growth now. But we'd counter that and say, well, the reality is we've been in a low yield environment for a long time now. And that has really been supporting a push into real estate from all sorts of different types of investors that may not have been traditional real estate investors before. And just to sort of make that point a little bit more clearly, if we look at what's going on in Europe at the moment, there's about 5.4 trillion euros worth of government debt, which is now negatively yielding. So you get a negative coupon. You effectively pay the government to hold that debt. And much of this is falling due. It falls due on a sort of rolling basis. And when it does so, investors are left thinking, well, where do we put this capital? We can either reinvest it into government bonds and take that negative yield, or we can think about putting it elsewhere. And it's also worth thinking that actually much of this debt that is maturing at the moment will be maturing off significantly higher interest rates than we've been used to in the past few years, so 3 or 4%. So the options to reinvest that in bond markets are really quite limited these days. And it's not a surprise, therefore, that we've seen a lot of this capital looking at different ways of getting into commercial real estate. Now, in terms of how it actually does that, just a few thoughts. We're really big proponents of this sort of ongoing theme of globalization of real estate capital. And we think that's got a lot further to run. And you could also make the point that actually in times of economic uncertainty like now, where actually some of the traditional trade flows are slowing in the wider economy, that it makes a lot of sense to diversify through things like real estate globally. That said, I mean, there are practical restrictions on people moving around in some parts of the world. And what we're expecting to see in the short term is a bit more of a focus on regional trade flows, and in fact that's certainly what we're starting to see in terms of investor behaviour at the moment. So more capital moving around within regions. It's still moving globally as well, but an increase within regions. People also are starting to think more about their strategy, or think differently about their strategy in this kind of environment. So whilst we can definitely make the case that actually with bond yields falling to record low levels, there could be an argument to say that real estate yields could fall further as well. But I think in reality, most people are now refocusing on the income aspect of property and really secure income, trying to find that where possible. And so that will have implications about where people are looking to deploy their capital. Typically those stable markets that survive well through all sorts of different economic environments. And then finally, this piece on sustainability, we don't think it's going away at all. And we're speaking to people all around the world at the moment, and it's fair to say there are very sort of different understandings of what this means for investment purposes and the importance of this at the moment. But I think as we go into this period of lower growth, investors will be looking at any different kinds of ways they can in order to drive performance, essentially. And so if there's a possibility of doing so through greater efficiencies and also achieving greater sustainability ratings, then we think they absolutely will do so.
Great. Thank you very much. So we're going to come on to address some of those points and also look at the points that we have to go through this morning about driving inward investment, what makes the UK attractive for global investors. Interesting point there about this trend of sort of regional investment, and how do we boost the brand UK PLC. And I'm going to come on to speak to Jackie and Alex about that in just a minute. But before we do, you mentioned it to there, Will, coronavirus. And I think we are really lucky to have Emily phoning in from Singapore. And we spoke about this just briefly before we started today. And it sounds like it's actually quite an encouraging or reassuring story coming from there, Emily.
Yes, I think generally things are looking a little bit more positive. I think we, over in this region, we're going through so I suppose the panic that the West is starting to see at the moment, and actually feels like we're coming out the other side. So cases in China coming to a standstill, South Korea cases dropping as well. So I think the feeling is that it's under control and being managed, and there's an end in sight. So generally more positivity. In terms of investment, appetite is still strong from Asia Pacific buyers to invest globally. I think just to build on what Will said, definitely we're seeing a flight to safety. So the investors we've met throughout the region over the last month or so have indicated that long income core assets in gateway cities are really what they're looking for at the moment in this longer late cycle.
Okay, thank you very much. So Jackie and Alex, and let's start with you, Alex, and then come on to Jackie. What are your thoughts on what Emily just said there, both in terms of the sort of the more general feedback on coronavirus and also on the impact on investment?
I think that we are really in the foothills of what's happening in Europe at the moment. But what we are seeing is a very rapid spread in Italy in particular. And to us, it seems logical that spread will work its way towards the UK at some point in the coming days, weeks, or even month. How long it stays here will then be down to the government's measures that it takes and down to the climate and the summer and other things. So our sense is that it's almost inevitable there will be a greater impact in the coming weeks, that will have a knock-on effect in the UK. Whether it's for a day, a week, a month, or 3 months, it's really hard to know. But then I think the good news is looking at China, looking at Singapore, as Emily says, clearly this thing has a life to it. So I think we're broadly optimistic in the medium to long term, but we're quite cautious and increasing our preparedness for the short term.
Thank you very much. Jackie, what are your thoughts?
Well, I agree with that. I think the worry is what the casualties will be in the business world in the meantime. So we seem to be riding almost a sort of a wave of the coronavirus as it moves from the east to the west, and inevitably particular segments of business are going to be more affected than others. For those of us who can work remotely will be less affected. But if you work, for example, in the hospitality industry, you are going to be very much affected by travel bans and by people's desire not to travel, even if they can. So there's going to be some pretty sharp lack of income into a number of those hospitality businesses. It's not just hotels; it's also the leisure industry generally, the entertainment industry, so venues, concerts, sporting venues. So it's whether those businesses can actually survive that short-term cessor of income, and then what that would mean for the premises that they occupy. So if you, for example, take shopping centres as another example, if shopping centres have to be closed, what does that do to an already struggling retail industry, where we're looking at a position where the sort of footfall, apart from in some of the prime centres, has been falling anyway. So that's my worry. What will the casualties be in the meantime?
And that sort of brings us on to this question of how the UK can get itself into the strongest possible position, both in terms of how the sector and how the logistics of the country and how it works is getting on here, but also in terms of attracting investment. And it's not just been coronavirus. We've gone from the B word to the C word, haven't we? Because, it has been a difficult few years. And before Corona, we had Brexit. And, just as we thought that it was, beginning to get into a position where things were calming down, there's this new challenge to deal with. So how can the UK get itself into the strongest possible position despite everything that has sort of been thrown in its path recently? And can I start with you on that, Alex?
Well, I think it's let's just sort of take stock of where we are in the medium term. We have very low interest rates and the potential for monetary policy to be eased. We have fiscal policy tools that we expect to see tomorrow with increased government investment, and we'll talk about levelling up. We have liquidity in the market that I've never seen before in my life, with literally hundreds of trillions of dry powder for real estate sat on the sidelines. So I think in the medium term, we're pretty confident that actually we have an asset class that can react well to what's happening. And we are protected because of lower volatility in real estate from some of the things we're seeing in the equity markets. Hence, I keep coming back to, in the medium term, we're very confident about the UK's real estate markets. And those are driven by population. Those are driven by limited supply. That's driven by demand, particularly for grade A assets. And it's driven by land. Land is a fundamental commodity. Half of the land in the larger farm sector last year was bought by overseas investors. A lot of the smaller parcels of land are going to residential. We're really confident in the medium term. And I don't think that we need to do much to continue to feel that confidence. I think what I am suggesting to our clients and indeed to our customers, the tenants in our buildings, is to be prepared for the short-term impacts, which will be predominantly the human cost of what we're seeing at the moment in the C word as opposed to the B word. But in the longer term, I remain pretty confident.
Thank you very much. Will, do you agree with that? What are your thoughts?
Well, I'd absolutely echo all of that. I think what I would add to that is, if you look at the places that tend to do well during times of economic uncertainty, they're often places where there's been great investment in technology, innovation and education. And I think if we can push those factors forward in different ways, then that will obviously help as well.
Thank you very much. And Emily, it would be useful to hear your thoughts on that as well, from obviously looking at the UK, but also from a global perspective.
Yeah, sure. So I suppose looking at from an age-specific investment perspective, in terms of Brexit, yes, it had some impact on investment volumes, but largely we think the drop in investment volumes from Asia into UK last year was really due to lack of stock, actually, as opposed to lack of demand for UK assets. When you looked at the global situation last year, Brexit actually didn't seem as big a concern to a lot of investors as it did to things like the Hong Kong political unrest and the US-China trade wars. So UK has remained somewhere of interest to Asia-Pacific investors, and we expect that definitely to continue and tick up in 2020, or certainly before the virus put some more uncertainty in the market. I think we'll start to see a move into alternative sectors, particularly from Singaporean government-linked companies who are looking for alternatives to drive up their returns, and they can build big scale in markets like student accommodation and senior housing. So I think that might be a trend we'll see this year.
Thank you very much. Jackie, I'm quite interested to see what your thoughts are on that last point there, alternative sectors. Is that something that... Oh, I just hit the microphone, so everybody. Is that something that you're noticing and seeing?
Yeah, we're seeing a lot of that already. So over the last 5 years probably for student accommodation, but certainly over the last couple of years for other bed-related assets, there is clearly keen interest both in the UK and certainly across Europe. So I think it was interesting what Emily just said about, for example, Singaporean investors. We're starting to see investment from both Singaporean government and private entities into the living sector or the bed sector. And I think that's an area that, whatever happens with some of the other businesses around the world, people need somewhere to live. Whether it's as a student, whether it's as a young person starting out trying to find somewhere to live for their first job, it's a family, or it's an elderly person who's looking for some sort of assisted type living as well. And that as a sector is the area that I think has potential for the best growth.
Thank you very much. And I would like to come on to look at areas where we're going to see growth, and I'm going to do that in just a minute. But before we do, Alex, you mentioned levelling up, and I think that would be really useful to go into as well. So how do you think government levelling up is going to impact inward investment?
Well, let's start with some of the numbers. London produced about 25% of the UK's GDP. That's about £500 billion. And the population is about 12.5% of the population. So broadly double it's the amount of GDP for the population for other parts. So clearly there is a problem and the government are trying to address it. But when you look back, in 1900, the gap between London and the rest of the UK was 30%, which is not far off where it is today. So historically, this is not something new. This is something that we just feel we have to address. As a business, as Fiera Real Estate, we operate across the UK through the 10 operating partners in which we're shareholders. So we're used to operating in every single major city and big urban area across the UK. And our sense is that there is plenty of opportunity outside the UK. What we need to do, though, is to put the transport infrastructure and the educational infrastructure in place to allow that transmission to spread outside of the UK. I shouldn't use the word transmission when you're using the C word, but you know what I mean. So we need to see that investment. We need to see government move its centre of power and centralisation towards the regional hubs, and they are doing that, to be fair to them. And I think that will be something that can unlock some of those cities. Although, final comment on this, cities like Bristol that are not in the southeast or London are already doing fantastically well. They've got good local government, they've got good investment in the town and cities, and they've got good technology, good business and good education. So we need to try to see that happening in other places across the UK. We can't make every part of the UK as vibrant as London, but we can certainly try to pull some of that economic growth out.
Thank you very much. Jackie, same question to you.
I think infrastructure is the key, to be honest. And in fact, to the sort of the points that you were discussing before about what can make the UK attractive, increased investment into infrastructure, which the government is certainly talking about, I think is another way of really opening up the potential, not just in the south, but right across the country. You've also got the potential Oxford-Cambridge high-tech corridor, which again would be a a really interesting boost to our sort of tech industry and our sort of education industry. But I also think, I mean, there are cities across the UK, like Manchester and Birmingham, which are every bit as vibrant as London in their own way. So actually, how do you attract an investor to those cities? So time after time, we talk to international investors and you say, well, have you looked at Manchester? Have you looked at Birmingham? Oh, well, we might have gone there, but we still just want the West End or the city.
Sorry, I would come back and comment. We as Via Real Estate have 90 assets across the UK. We own nothing in London for our overseas clients. We very specifically have said to our particularly Middle East clients and our US and Asian clients, guys, there's great value to be had out of London. You can probably execute in London without a manager like ourselves because it's such a deep and liquid market. And we found actually a lot of client appetite. That's not to say they're going to Grimthorpe or wherever that small town notionally might be in the middle of nowhere, but they are very happy to invest into Edinburgh, Glasgow, Leeds, Bristol, Manchester, Birmingham, and long may that continue.
But that's great to hear because that's the fear, that people might talk about it but not actually do it. So to hear that they're actually doing it is really positive. One other just small point on this, again, going back to infrastructure. So if, for example, you invested in things like ports, again, that's the sort of international type of asset that might attract international investors to a location which is outside the southeast.
Yeah, I have obviously personally invested in port, but then I found it was the liquid variety, which wasn't actually the one you were talking about.
Thank you very much for that. Will, I'm quite interested. I mean, to find out what your thoughts are on asset classes gaining traction. I mean, Emily mentioned it on the phone there, and Jackie mentioned it as well. And Emily was mentioning, alternative asset classes. What are you seeing when it comes to that at the moment in terms of international investors and what they're really looking for?
Well, I think fundamentally the issue, as we've all said, is that there's still huge amounts of money targeting real estate, and actually the pool of capital targeting real estate is growing far faster than the volume of assets that it can actually invest in. So it's having to look at other places to invest. Alternative assets, however you want to describe them, are clearly of real interest at the moment. We've done some analysis to look at how a sort of theoretical private equity fund might invest in or try to invest in the next 10 years if we were in sort of 2027, say. And we can see them trying to invest up to 50% of their portfolio into non-traditional types of real estate. The challenge, of course, is where do they find that stock? So in reality, investors of all types that are going to try to get into these kind of assets will probably need to think more about forward funding, which we're now starting to see a lot of in certain parts of those sectors. But I think generally that is where a lot more capital is going to be directed to, and that isn't to say that that the traditional sectors, the offices, for example, are going to see less capital. I think that the size of the pie is going to be growing as well, and we're seeing that at the moment with lots of demand for institutional capital, for example, to look at placing slightly higher weightings on their real estate parts of their portfolio.
Thank you very much. So, Emily, I think you are excellently placed to answer this question first, which is how is UK real estate performing compared to other global markets? We've talked a bit about the UK in isolation. We've talked about the global overview, but in terms of how the UK is actually performing in the midst of everybody else at the moment, what are you noticing?
Yes, as I sort of mentioned, there was a drop in transaction volumes in terms of Asia Pacific coming to UK last year, but I think that was largely a global theme due to lack of stock. So I think we're expecting it still to be one of the top markets for Asia Pacific investors in particular. We've seen the Koreans step away slightly from London, the UK, and move towards Europe, largely due to the positive carry they can get from the euro as opposed to the won, which has been particularly lucrative for them. Singapore has kind of stepped into that place, and really we expect Singaporeans to continue coming to the UK, not just London, but as we've mentioned, alternative sectors, business parks, industrial, so really across the board. Hong Kong as well, we've seen, because of disruption in their market, a significant uptick in outbound investment, and this is largely directed at London as well as partly Sydney. Malaysia as well, we're seeing an uptick this year, and we expect that to continue. And actually expecting more to come from Japan and Australia over 2020, which has been slow over the last couple of years, but there's a lot of capital waiting those markets, and we know that US and the UK are two key target markets for them. So I think, particularly in the current environment we're in, where there's a hunt for perhaps safety and quality, UK particularly stands out. And if you look on relative terms, generally on a yield basis, compared to similar opportunities in Europe and increasingly Australia, etc., UK actually looks pretty good value. So I think we'll continue to see investment from Asia coming into the UK this year.
Thank you very much. I'm conscious of time, and I wanted to give everybody an opportunity to do their closing remarks and comments and what they'd like everybody who's listening to this or watching this to go away with today. But if you wanted to address that issue of how UK real estate is performing compared to other global markets and your final thoughts, then please do. I'm sort of amalgamating two questions into one. So Jackie, can we start with you? Final thoughts. What is it the message that you'd like people to go away with after this session?
So I think we've all talked about some of the short-term problems facing us, but I think what I'd like us to do is focus on the sort of medium to longer term. Okay, we're going to have a bit of a rough ride for the next few months, but we'll get through it. We always do. And looking longer term, I think the UK does present a very stable environment still in which to invest. We still do have a very transparent legal system. Okay, there are one or two things going on, like registers of beneficial interest, which might put off one or two people. But overall, we're pretty transparent. Our tax system, much as we may moan about it, and its complexities, is actually, again, reasonably transparent to investors. So I think we've got a lot going for us. And one thing that no one's mentioned yet, ESG investing. And I think that's something, again, that over time, as a nation, the more we talk about climate change, the more we talk about what we can do to mitigate that, the more that will help investors who have very strong ESG policies to look at the UK as a location as well.
Lovely, thank you very much. Will, final thoughts?
Well, look, I definitely agree with the ESG point, and I think you could argue that the UK is building up a competitive advantage in understanding, at least, of that type of investment strategy. But in the short term, though, I'd also just come back to what makes the UK a really attractive investment environment, which is liquidity and scale. I mean, the UK is one of a handful of markets globally that sees the scale of investment that it does, and that really comes into its own in times like this.
Thank you very much. Alex, final thoughts?
I would comment that the UK's underperformed the rest of Europe since the 2016 referendum, that whether it's somewhere between 7 and 9%, that creates an opportunity. So for us, the UK starts with that advantage. And if I was talking to everybody, I'd say plan probably for a more difficult 2020 than you expected it to be at the start of the year. But in the longer term, be optimistic. Think about the income, because that's the key component that you can deliver. Think about the quality of assets, because they will have lower obsolescence, they'll be more attractive, and prepare for a changing world, both from a technology point of view and from a climate point of view. And all the decisions you make now, plan out 5 or 10 years what you think it's going to be then.
Thank you very much. And Emily, final thoughts from Singapore? Ooh.
Final thoughts from Singapore? Yes, sorry. I think it remains, and this year will remain to be a safe haven for investors from particularly this part of the region. And we expect, even though we've got some uncertainties and some difficulties, we expect a strong lot of outbound capital to be heading to the UK this year across various sectors.
Lovely. Thank you very much. Well, it's been a great session, with or without the sunshine and the beaches. Thank you so much to everybody for joining us, to Emily and Jackie and Will and Alex. And if anybody wants to find out more, they can pick up a copy or see online a copy of our Global Cities Guide, which has been released in partnership with Knight Frank, Hogan Lovells and Ten Design, where we go into some of these details. That sounds a bit specific, where we go into some of these topics in more detail. That's the way around. So thank you everybody for joining me. And it's nearly midday, so I think all the sessions after this will be we'll have rosé attached.